Hello, listeners, and welcome to another episode of Cognitive Dissidence. As usual, I'm your host. I'm Jacob Shapiro. I'm a partner and the director of geopolitical analysis at Cognitive Investments. I didn't intend for it to work out this way, but we have put out a podcast every single day this week, and that continues with our Friday weekly check-in. Rob is off gallivanting around Southern England, so joining me is Chase Taylor, our favorite Pinecone macro podcaster of repute. Thanks, Chase, for making the time. It was a great conversation. Listeners, if you want to talk about becoming a CI wealth management client, or if you want to talk about the research and consulting services we offer, you can email me at jacob@cognitive.investments. Otherwise, enjoy the episode. Cheers and see you out there. Cognitive Investments LLC is a registered investment advisor. Advisory services are only offered to clients or prospective clients where Cognitive and its representatives are properly licensed or exempt from licensure. For additional information, please visit our website at www.cognitive.investments. The information provided is for educational and informational purposes only and does not constitute investment advice, and it should not be relied on as such. It should not be considered a solicitation to buy or an offer to sell a security. It does not take into account any investor's particular investment objectives, strategies, tax status, or investment horizon. You should consult your attorney or tax advisor. Filling in for Rob, who is somewhere gallivanting through the English countryside. Poor him. But you and I, Chase, back to the grind. How's it going, man?
Yeah, everyone has been taking awesome vacations all summer, and I just been steadily on the grind. Although we do head off to New York next week, which is where everyone's escaping for vacation. But here we are.
I have Portugal at the tail end of the summer because my college roommate is getting married there, so I have that to look forward to. But I'm with you. It's been a grind, and it's been, as somebody who likes hot weather, I saw one of your recent pieces that you put on Pinecone Macro. By the way, listeners, we pimp it out all the time, but if you're not checking out Pinecone Macro, like, do yourself a favor and do so. But yeah, I know you're from Texas. I grew up in Georgia. I'm used to heat. I like heat. Like, I never really complain about heat. This summer in New Orleans has sucked balls. It's really bad. It's the first time in my life I've ever been like, oh, maybe I do miss upstate New York. Not really, but just a little, you know?
Yeah, I've never been a fan, I don't think. As soon as I got out in the Air Force and felt what like dry felt like without all the humidity of the Gulf Coast, I was like, the first time I went home, I was like, nope, not doing this.
Well, I don't have a good humidity-laden segue, so to connect, maybe you can connect humidity to inflation. But it was auspicious that we had you come on and fill in. I wish I could say that I was, organized enough that I planned it this way, but we've got a new CPI print this morning, and I thought it was worth talking about the CPI print a little bit. The general narratives that the media is basically reporting is that, inflation is coming off the boil. Inflation is starting to go down a little bit. And yes, the CPI only increased 0.2% in July and is only up 3.2% over the last 12 months. I would encourage listeners, go look at the BLS website with the CPI print. They have a lovely chart on the left-hand side of the news release, and you'll see that we're still dealing with 12, 13% drop in energy prices, but we're still 5% inflation for food, almost 5% inflation for everything less food and energy. Shelter has been up big this month. So I don't find much complacency or comfort in the CPI print, in part because of energy prices, which I'm sure we might talk about it now or we might talk about it later. But I'm not particularly sanguine that that these very low energy prices are going to stay the way they're going to stay. But what are you seeing in the CPI print, and how does the inflation print and how does inflation in general work into how you're thinking about the economy for the rest of the year?
Yeah, so inflation is one of the few things I think I've gotten right over the last year. I've been in the camp that it's going to go way down and more or less stay down. I made fun of transitory and said, we were going to have really high inflation. And then I pivoted to making fun of people saying that persistent inflation. I kept saying persistence is the new transitory because it would be just as wrong. I still think that, but yeah, I mean, headline inflation, just because of energy year over year, is going to, start to move up a little bit. But, when you look at the construction of the CPI, is core CPI, however you want to look at it, shelter is such a massive part of it. And we basically know shelter is going to go down for the next year or two within the CPI. So whenever the overwhelming majority component is going to go down for the next year or two, there's there's really no reason to be fearful of inflation. I don't think, especially core inflation. And I think, so about a year ago, maybe it was 2 years ago, Jay Powell was like going out of his way to be like, hey, we really care about headline inflation because that's what everyone's looking at. That's what everyone's feeling. And if you noticed last month, he pivoted back to, what we really care about is core, because that's what's going to really tell us the story. So I think the Fed knows, like, hey, energy is about to go back up, things like that. So we're going to focus on core because it's kind of obvious that's going to keep going down. The other half of that where I was wrong, though, was, and I even thought we could have the immaculate disinflation where you don't even need economic weakness to get rid of most of this inflation. But I thought we would get the economic weakness just because I figured, the economy was not going to be able to handle 5% rates. And so far it has, obviously. But, I mean, at the same time, we know, and it's really just math, that if you refied everyone into these rates, the economy would collapse overnight. Obviously, that's not how it works. That's the big reason we haven't had problems is so few people have had to even feel the rates because they've extended their maturities and refied and all that kind of stuff. But as that kind of kicks off, more and more people have to roll into that, then that will start bringing the economy down. But when it comes to inflation, I just don't really think it's gonna be a problem other than headline inflation having some pop on things like energy. But when you compare the size of energy's importance to shelter, it's very difficult for it to pull the whole index higher, at least near term. Obviously, if you get up to $170 oil or something, it will seep into everything else over time. But
yeah, although despite the Saudis' best efforts, we don't seem to be there. But let me ask you a little bit more about shelter, because you said you felt pretty comfortable that shelter was going to go down over the next 12 months, and I haven't really looked closely at that. And when you look at the print for this month, I mean, up 0.4% over the month, but unadjusted 12 months, it's up 7.7%, which is one of the larger figures. So what are you seeing shelter-wise that makes you confident that we're going to see that number drop here over the next 12 months?
So that's down from 8%. The biggest thing is the way it's constructed. First of all, it's dumb, but it works with like kind of an 18-month lag. So there's a lot of like survey-based stuff that they only do quarterly, things like that you end up with this like massive lag. So if you watch, say, Case-Shiller Index or apartment lists, like rent statistics, things like that, Zillow, a lot of people use Zillow's kind of real-time data for either house prices or rents, and then you plot that against what the Feds or the government's looking at, then you can kind of see that where that lag is. So we just know, based on, even if you mushed all those different private sector views together, and then created that lag, you would see all those kept going down from this point. So this just kind of, home prices are down year over year, and rents are down year over year, and yet we have 7.7% housing inflation. And that's just because of that lag, because 2 years ago, 3 years ago, we had 7-8% housing inflation, really higher. So it's just like the natural gravity of the way the thing's constructed that's going to continue to bring it down. So even if house prices started to really reaccelerate, it won't capture it for another 18 months. So something like that. I say 18, but really it's kind of like 12 to 20. It's kind of difficult to even map that out at times, but it's very clear that's the way it's going to work. And the funny thing about inflation is, if you used, say, just the Case-Shiller data today, and Jeremy Schwartz has done this over at Wisdom Tree, and you plug that in instead of what the Fed's looking at for the housing inflation, then the CPI is under 1% right now. So if you just use real time, no kidding data for housing, inflation's like incredibly low. It's well below target. And even right now on a 3-month annualized basis, I mean, you're basically at target. So to me, inflation is like more or less a non-story that everyone still thinks is a story. And I think one of the reasons we were at Bulwark were slow to kind of get bullish on equities in any way was the lack of realization how much the market stopped caring about inflation. And I think that, I mean, looking back, you should have expected that because inflation was kind of clearly over with. But for me, I was looking for the lag reaper this whole time to start hitting macro data, and at the end of the day, it was the lag reaper's been doing a lot more lagging than reaping. So,
well, but he'll come eventually. But I take your point there, and in some ways, this all comes down. It becomes less a question about what's actually happening with inflation, and more about how is Jerome Powell and his merry bunch of cronies thinking about inflation. Do you and you sort of noticed a pivot in Powell's language. Do you think we're like so? I mean, I hear that you're saying that you don't think inflation is a big deal. Powell at least is still talking like inflation is a big deal. At what point do you think the Fed comes around? Probably they come around when inflation does reaccelerate, if they sort of hit their their last couple targets. But
yeah, this has been a tough one for me to kind of figure out, because there's a big part of me that thinks like they're done now, like they won't even. I think this CPI probably, it made a pretty good chance they're not moving in September. Maybe they would in November if we reaccelerated, but I cannot see core accelerating enough for them to care. Like I could see a headline popping back up, but and part of me feels like the political pressure of that would get them to move, but at the same time, they're probably gonna have political pressure from DC to be like, hey, we're pretty close to the election, like let's maybe not do that. Even 6 months ago, roughly, he gave a speech, and it kind of surprised me because it was dovish. Granted, they've been plenty hawkish since, but where he really leaned on supercore, which strips out food, energy, and housing. I think it was a recognition of, hey, this housing data is like, it's so lagging, there's no point in relying on it, so let's go look at supercore. And supercore has been coming down steadily. It's really not even that worrisome anymore. Core, still a 4.7, that's obviously well above where they want it. But if you kind of look at the glide path where it's likely to go based on continued disinflation at housing, then my guess is, there's really nothing for them to worry about, especially where they have rates. Like real rates are now positive pretty much across the entire yield curve. Something I like to look at is nominal GDP, and then subtracting the 3-month rate. So essentially the policy rate versus nominal GDP. And even that is about to go negative to where your rate's going to be positive, even versus nominal GDP. And that the last 5 times you have had a recession, you also had 3-month rates higher than nominal GDP. But there's a false signal in there, so that's not like some this always works thing. But that shows you like you're really tight whenever you hit that level. Mm-hmm. And to me, like they're really tight right now. And as every time inflation goes down a little bit, you just get tighter at that point. So something I was kind of struck by is, and I think the most important thing to think about when it comes to the Fed is this. They've started to talk a little bit about, hey, like if inflation's coming down enough, we will actually just lower rates even if the economy's not doing bad, just because that will make us, that'll show us that we're just getting that much tighter, and we don't want us to just stay at 5.5 if inflation's back at 3. Like that would probably be too much. My gut tells me they're not actually going to do those cuts though, and maybe I'm just wrong. And the only way to get a soft landing would be like a real soft landing would be to do proactive cuts without economic pain. They're talking a good game about it. Like there's been a couple of them actually mentioning it lately, and Powell talked about it during the last presser. But I think saying that and then actually executing on it while inflation is say still 3 is just that it'll be tough for them to pull that off. And one last point I'll make is going back to the housing data. One of the things that's interesting to me is it's going to be very difficult for the housing data to even kind of turn back around and go back up. So you could end up in a situation where you have sort of like housing deflation, I think, even in 2024, specifically on the rent side, which is part of the computation. The supply that's incoming for apartment buildings is just massive. It's like the biggest in history without that much population growth. And in an environment where apartments are already loose, like availability is fine, like their vacancies are essentially higher than pre-pandemic, and we're going to throw hundreds of thousands of apartment units at the country. So I think it's going to be very difficult for rents to really move up in the next 3 or 4 years. And then home prices, I mean, they essentially cannot move up until you get mortgages back probably below 5, something like that. So very difficult for housing inflation to be a problem, and it's the biggest piece of the inflation metric.
I can't help but think of China when you say about, lots of apartment complexes and things like that, and vacancies are up, and we haven't even talked about office real estate and the problems that has had. And I did want to sneak China into the conversation too, because I know we started off with the U.S. CPI print and the Fed and things like that, but it struck me when you said if you strip out all that data and don't use what the Fed is using, that you're around 1%. China is seeing decreasing CPI, producers price index decreasing markedly. And I think we're accustomed to thinking of, the United States catches a cold, the entire global economy catches a flu, the United States is the global engine of the world economy. Yes, that's all true, but China is the world's factory, and everybody's been talking about China, lost decade, and deflation and deflationary crisis and things like that. But I wonder if there isn't something a little prescient in specifically the factory data in China disappointing so much to the downside, because it's not just China's whole problem is that they don't have domestic demand. So the fact that those prices are going down, that means that everybody else is consuming less from the Chinese in general. And some of that is the trade war. But the U.S. and China have also tried to put geopolitical tensions aside here for the last month or two. So maybe there's also something in that we should be paying a little more attention to. Do you think that's a stretch?
No, not at all. I mean, they are. I've always kind of called them the global macro keystone, because they're the ones that move a lot, and their movements they just impact everything else. I think that's lessening a little bit, but yeah, I mean, they have outright deflation at the moment. And obviously, I don't think it's going to stay that way. They'll get back into an inflationary environment, but it's not easy at the moment to imagine it being, back to normal with the lack of demand. And it's interesting to me, obviously their exports have just fallen off a cliff, and I think everyone knows by now, Canada, Mexico, we get more imports from them individually than we do China now. But part of you might expect, well, yeah, the U.S. has been their biggest customer, but they'll probably replace the U.S. with exporting to other things, because over the years they've been so efficient at increasing their exports with everyone they have a relationship with. But then you look at their exports to, all the Southeast Asian countries and all their other friends around the world, and they're really not having much success there either. So I think their biggest customer is walking away in a significant chunk, and they're not able to replace it yet, at least around the world, which in a way might be good for them, because none of their kids want to work in a factory anyway. But they're going to be so slow to pivot away from their model that it's hard whenever the only buttons you know how to push just do not matter anymore. You don't need more infrastructure. You don't need more manufacturing or exporting capacity. You've decided that you don't want to just have a giant housing bubble anymore, and that was the easiest button you had. So you're just out of easy buttons, and they don't seem like they want to do, the more difficult but correct buttons, other than to apparently throw some food festivals. I guess that was how they thought they were going to get out of this, but. Yeah, that's gonna be a problem, and it's another reason it's difficult for me to really understand where all the inflationistas are coming from. The biggest exporter in the world is exporting deflation. It's a really difficult environment to have high inflation. And when I say high, back above 5, but I think we all know tons of people that are in the 4 to 8% structural inflation camp. And to me, if you're going to have that, you need some inflation, not deflation, coming out of the factory of the world.
I don't know if the inflationistas and the commodity supercycle people are the same people, or where they are in the concentric circle, but I imagine there's a lot of overlap between those two groups, because I think when you're thinking about long-term, I have a notion of higher inflation than we've had in the past, just because, to your point, if everybody's going to go away from China, well, those are whole new supply chains that you're going to have to rebuild. So that's going to require some upfront CapEx, and you've seen companies putting that sort of CapEx in. But I think in general, the argument for higher prices is that, so we're not going to get cheap commodities from China anymore, and agricultural commodities are not cheap anymore because of Russia, Ukraine, and the Black Sea and things like that. So the price of copper and wheat and all these other things are going to go up. And I've been skeptical of the commodity supercycle argument on this podcast before, because I don't even really know what it means. there will definitely be a moment in the sun for copper, but is it going to be this year? Is it going to be 3 years from now? Like you're sort of going to have to time it right, but it's not like you're going to buy copper today and put it in your bookcase, and in 10 years it's going to be like worth 5x, right? So, but I imagine there's some overlap between those things.
Yeah, that's true. And I'm kind of sympathetic to commodity super cycle while not being that sympathetic to like high structural inflation. 2.5%, 3% as like kind of a new normal, like that makes sense to me. And I think that should not, and it should be tolerated too. It's just going to be more like the natural rate of inflation in this environment. And I do think, hey, reshoring, onshoring is going to create some inflation. I just think, just the labor supply being lower is going to be somewhat inflationary. I believe in I've been, in 2018, 19, all I was writing about was all the inflation that was coming. Now that it's here, like I feel like people they've extrapolated a little too hard for me, but I do think most commodities are going to be structurally high for a long time. Just for no other reason than we kind of forgot to invest in them, and no one wants to work at like the same way that the kids in China don't want to work in the factory. Like most of the kids in the US don't really want to go be geologists or mining engineers or petroleum engineers either. So that tends to make things expensive. So I think that 2.5%, 3% is going to be normal. I think commodities are going to be high for probably the next decade. I don't get as excited as some people do about maybe the super cycle, especially for things like copper. Obviously, all the electrification is going to create tons of demand. And eventually that demand can kind of take the baton from Chinese demand, but right now I just don't think it can, and not at scale. Even when housing starts to bounce back in China, I just think the kind of square footage under construction was never going back where it was with the declining population. And that is 20% of the world's copper demand is just straight up China building houses. So it's not easy to quickly replace 20% of demand for a giant commodity. We'll get there, like EVs and the whole nine, like it requires a lot of copper. We all get that, but 20% is a lot.
Why don't we pivot a little bit? Well, I was going to save this for the end, but maybe let's talk about natural gas now, and then we can get to the two other topics that I wanted to talk about, because you mentioned political pressure on the Fed. And if we've learned one thing from the Biden White House, it's that they do not like high prices at the pump. Like that was the thing that set Biden off and on his anti-inflation crusade and sort of everything else. And I think that's an antiquated way of thinking about these sorts of things. But as you said, like the Fed and the U.S. government is not exactly in the business of being at the cutting edge here. We talked a little bit about natural gas the last time you were on this podcast. At CI, we've been very bullish natural gas really for the last 8 weeks or so, and we have a report out about that if people want to find it and things like that. But we're, at least it looks like we're starting to get initial signs that maybe that thesis is playing out a little bit. So I'll give you a chance to riff here on natural gas and maybe how that ties into some of the energy things, because I've been, the first half of the year I was very skeptical about oil prices in particular and energy markets, and I was the one who was out here saying there wasn't going to be a European energy crisis and things like that. But I've started to, the spidey sense came about 8 weeks ago, and I'm getting increasingly I'm increasingly thinking that we're looking at higher energy prices across the board here through the end of the year and maybe into next year. So what are you seeing on your end?
Yeah, I totally agree. And I was very bullish a few years ago, and on your podcast a couple of times talked a lot about it. But I still remember surprising you whenever I won't say I turned bearish, but like I just wasn't bullish anymore. We hit double digits. We hit that $10 mark in the US, and I was like, that's enough. Okay, got out of the way. But then we got back under 3. And it's like, well, here we go again. Like, and we literally went from talking about banning exports because the US did not have enough gas to talking about not having enough storage for US gas in a year. Like that's just still stunning to me. And both were obviously just wrong and over extrapolating where we were at that moment. I'm very bullish, but I will say production has been annoying. Like production has stayed super high. We well over 100 BCF. So that's been kind of annoying, and I keep waiting for that to fall for the bull market to like really start. But obviously the heat has done its job. My motto with gas is that summer is the new winter, that everyone only thinks about winter for gas, but summer heat and all the cooling demand that comes from that is just as important as heating demand is in the winter, because so much of our grid comes from natural gas plants. That's starting to work. Like, it's been so hot. I mean, July was the hottest month in the history of the world, or not history of the world, in the history of the recorded temperature in the world. So I mean, that just creates a shocking amount of cooling demand, especially lately. You know, gas has been so cheap that everyone's using it. So no one's like messing around with coal or anything hardly. So everyone that could switch back to gas did it. So you've had power burn that has been really significant. That, I think that continues. I think you'll have enough heat in August, September to keep, you know, the injections small. The key is going to be getting that production down. We've laid down tons of rigs, so we know like eventually that comes, but it comes with a lag. So we'll see how long that takes. But yeah, I mean, we haven't even had, you know, here we are, it's August 10th as we record, and we haven't even had any activity in the Gulf yet. So if you get some hurricanes to go in the Gulf and start messing with production, then you can like really get some of those spikes in the spot price, with some of the production offline, you know, on and near the Gulf. And yeah, as we just saw when it comes to LNG and European prices, you know, I think a lot of people got to the point where like, whatever, like there's a glut of gas now in Europe, like this is not even a problem anymore. And your spidey senses were right, and they got validated by, you know, some Australians just talking about a strike, and then boom, 40% in a day for LNG prices to Europe. That tells you like, okay, this is still a market that works on very thin margins. Like there's no margin for error, or you get, you know, pretty shocking price spikes. And come wintertime, you know, if you have a month of just pervasive cold in Europe, that's going to be the same or a lot worse than having some LNG workers go on strike in Australia. So it's such a thin market. Like there's no room for complacency, especially in the winter when the math is like such an ugly treadmill where you can, you know, literally kind of run out of gas towards the end of winter just based on the math, because the inflows can't keep up. So it's something that requires a lot of humility. And I think a lot of people have let their guard down on any sort of energy crisis. And usually when people are looking for it, you don't get it. And usually if you're not looking for it, that's when it at least has the potential to kind of become a problem. So keep listening to your spidey senses. They've been right for a couple of years.
Well, I echo everything you say. And well, even though we're long natural gas, I hope that the Gulf continues to stay quiet. It has been, it's been eerily quiet here. I mean, we haven't even had a hint of a threat of something. Usually we've got one or two things that, you start to get ready and then it veers off into the other direction. But there's been sort of zero here in the Gulf so far. Daryl, who is my weather guy who comes on the pod.
Yeah, and the Atlantic's boiling. So.
Yeah, but you know, it's the wind shear and the El Nino, and Daryl's going to get mad at me for saying, hey, El Nino means no hurricanes in the Gulf. But hey, like this year it's working. El Nino seems to mean no hurricanes in the Gulf. That's just for Daryl. But to your point, yeah, and you know, when we're thinking about Europe, like last year I was very sanguine, and their storage levels are also very high, but they're still getting a significant percentage from Russia. So what if this Russia-Ukraine war gets even more serious? What if it goes from the Black Sea to pipelines? Poland sent troops to the border. Like that's not an unrealistic scenario. And then the other part of this is also, I think we miss the importance of Asia, especially when it comes to LNG as well and all these other things. Nikkei had an article this week that really sort of stuck out to me, because I knew that, you know, Pakistan was having trouble sourcing LNG, but that makes sense. Pakistan has a balance of payments crisis and is begging for money from the IMF and from the Saudis, and like nobody wants to sell them natural gas because they don't think that the Pakistanis have any money, because they don't have any money. And the Pakistanis have said, okay, we're going to go to coal because that's what we've got and we can't get our hands on LNG. But Nikkei had this report about how, you know, Vietnam and the Philippines were also turning on sort of LNG plants this year, and they haven't been able to source long-term contracts. Nobody's willing to sell them long-term contracts because they've gotten them from European countries or from your Chinas or Japans or South Koreas that are willing to stomach the higher cost and which are more reliable in terms of payments and things like that. So it seems to me maybe we're also moving to this point where, I don't know, there's just not enough, like even though supply is good today and storage is good today, there's this expectation of the glut of supply that's coming in 25, 26 with Qatar and Canada and everything else. But that's 25, 26. And now you've got gas plants coming online and the tight market that you alluded to and all these other things. So when you just start to put it together, it just feels like there's this mismatch in the market. It almost seems too obvious to me. I'm starting to doubt myself on it just because it seems too clear. Maybe I've been reading my own stuff for too long. I don't know.
Yeah, and but I will say I've missed some good trades because they just seem too obvious, and then turns out, oh, well, that was right. But yeah, that's a good point. And I think if anything, the world needs Japan to go all the way back to nuclear so that they can either, lay off LNG or at least become, a middleman that, kind of just does what China did last year and like, oh, well, we bought a bunch of LNG, but we don't need it, so you want some? Yeah. Like just kind of arbitrage the difference between, supply and demand around the world. But that's been one of my concerns for LNG was just, okay, well, if they do have success, even South Korea getting back to nuclear and stuff, if they all kind of lean into that enough, then pulling Asian demand down. But to your point, I mean, there's so many countries that don't really use it now that would love to. So I'm sure all over Southeast Asia, they would really enjoy getting, switching gas for coal is really, really nice for, your street cred on climate. It's good for your street cred with your population for not having to breathe the air with coal. And I'll say, like, if you're an American, or I would say Western European, but they have so much coal, and Germany may be a bad example, but if you're an American and you haven't had to deal with the air quality in some of these places, like when you deal with it, it's kind of shocking how bad it is. Like it kind of messes with your day-to-day life. Just spending some time in Korea, and some of it was just like coming over from China, and it's just like brutal. Like you feel it burning inside of you. Like it's not a small deal. So I promise you that a lot of these places would really like to move away from coal and get to gas. So it's just a matter of getting the price to a less volatile level. Getting, whenever you get those long-term contracts, you can afford to do that. And this is still a really young market. I mean, tying the price to oil, this is just now starting to go away, things like that didn't make sense. So as this market grows up, it's going to get bigger, and I think the demand will always be there, and supply won't always be there at the end of the day.
I haven't been back to China since 2008, but I was in China in 2008 and was all over the country. And I was in Beijing for a couple days, and it was a particularly bad time with air quality there. And I have bad sinuses. I have stomach like a rock, like everything is also great, but my sinuses have always sucked. I was laid up the entire time I was in Beijing. Like I could not deal with the air quality. So anecdotally, I sort of hear you there. And I also wanted to dwell on what you just said there for a second about how the good trades are the ones that are most obvious. The more I do this and the more I think about these things, the more that seems to be really true to me. Like, unless I can say it to myself in 2 sentences and feel very confident, it almost isn't worth it. No matter how elegant and smart something sounds on the speculative side, like the best trades or recommendations, I've made to the research team at CI this year have been the ones that are like, hey, I don't have a 10-page piece on this. I have literally 4 sentences. Like, there's too much of this. There's too little of this. Here's the risk. Like, here's the trade. Like, I sometimes think all of the fancy sort of analysis is sort of not wasted. Like it's the bedrock that allows you to do those succinct views. But I know that I'm onto something when I can say it in 2 sentences. Before we leave energy and get to Japan, because I really wanted to pick your brain about Japan. I remember the conversation we were talking about energy when you were on the podcast, and you were really the first person who made that call for me. But I think that was I can't remember if that was it was either pre-pandemic or shortly after. I think it was pre-pandemic. Anyway, but coal was the other thing that you really turned me on to. And I've looked at coal pretty closely ever since you and I first started talking years ago now. And I was expecting higher prices for coal so far this year, and that has not panned out thus far. But I think it's fair to say that hasn't panned out because natural gas has been so cheap, and you don't get the conversion over to coal unless natural gas prices get high enough. This is what happened in the United States last year when natural gas prices went really, really high. You had the highest coal consumption in the United States in years, even as the EIA and the IEA and all the other A's said, oh no, coal demand is in structural decline, things like that. So if we are right about natural gas and oil, coal is probably going to rise in sympathy. Do you think it's linked, or are there things to the coal market itself that you think are separate from the natural gas story?
For me, speaking of keeping it simple, I always just view it as sort of like you get thresholds on gas where it just comes alive. And to me, it's mostly about gas whenever it comes to thermal coal. Obviously, it has plenty of its own idiosyncrasies, but at the end of the day, it just kind of has to have gas doing well enough to really turn itself on. And then, but when it does, it'll do more than gas. That's kind of why I like it. Is once that gas bull market gets going, then you put a little bit in coal, and it's just going to do more than whatever gas is doing typically, especially the equities, because the equities are so shockingly cheap because everyone thinks coal is going away in 5 minutes, that no one's willing to put any real valuation on them. Plus, so many people just literally can't own it because of the ESG mandates. So yeah, I mean, it's just like a really high octane way to play gas at the end of the day. But like I say, like at $2 gas, like no, because no one's going to, at least in the US utilities aren't going to go burn it unless you get to a point where it's so much cheaper than gas. But from a supply and demand standpoint, people have been kind of predicting the demand side to roll over for a decade, and then every time I turn around, it makes a new high for global demand. And whenever you have China, India, like kind of all in on it, like a lot of Southeast Asia, like it's not going anywhere. But even in the US, I mean, we still burn a lot, and we've given it up way more than anyone. Obviously, Germany is burning a tremendous amount as they go backwards by 200 years for energy. So yeah, the demand's going to be there. It's not as simple as gas, but I make it as simple as gas for my own, kind of investing purposes. And then there's met coal, which for making steel, which has, you would think in the industrial slowdown that we're in globally, that would be struggling, but you go look at some of the met coal producers and they're doing great too. So it's kind of a two-pronged thing with coal at the moment. You could kind of go both ways with that.
Well, yeah, to your point, I mean, coal equities don't actually look that cheap to me. So Peabody, for example, January 4th, 2021, $3.21. Today, $23.16. So like I've sort of been watching, the charts of some of the coal stocks and thinking, all right, like can we get a little further down? Because I would like to bite off something here and chew on it, but it feels like maybe people have gotten smart and we're not going to get down to those low levels before. So do you see the opportunity now? Do you think it has to come down a little bit more? Do you like the valuation now on coal equities? Like what's your thoughts on timing there?
Yeah, so I mean, I'm fine with them where they're at. So if you think about, I actually bought a Peabody under $3 back in that cycle. And yes, like it was a 10 bagger and that was a wonderful time. But if you go look at where it traded after that, it was still cheap. Like you're talking about a PE ratio of 3. So it's still, or price to cash flow is under 2. So their EV to EBITDA is 1.2. So when you go look at all the ratios, even though that share price has done what it's done, it's still cheap. It's just a matter of literally people thought it was going to go bankrupt back when it was under $3, and that was kind of what was priced in. I remember I did another podcast. It was the first time that I publicly kind of talked about Peabody as an investment that I liked, and really smart hosts, and they were both just like, man, what are you talking about? This thing's probably going to go bankrupt. Like, I feel like I could feel them being nervous about me even talking about this on the show. And then it just went on a rampage. But it's still cheap. Like all of those names are still cheap. And for no other reason than, A, no one wants to own them. And then B, institutions, they kind of can't. So I look at somebody like Warren Buffett, I feel like I'm kind of surprised, honestly, that he hasn't just whole cloth bought a bunch of coal producers. He can't go buy 20% of the shares because like that would be, a rounding error in his portfolio, but he might be able to, and honestly, that may be the case, is like, he might be able to buy the entire like coal industry and it not be enough of his portfolio to matter, for all I know. But I remember looking at that analysis for like uranium miners back in the day. It was like, and why does this one like Buffett buy? There's just so much value. And then I looked at it, I was like, well, it would be less than 1% of his portfolio to buy literally all the uranium mines. And I was just like, okay, well, like, okay, yeah, of course he's not going to do that. There's no point. But it can't even move the needle for him. But it shows you like how cheap some of this stuff is at times. But you know, you look at oil and gas, like that's almost the oil, gas, and the Japanese trading companies the only place he's put money in the last 5 years. So, and more, I guess more Apple, I call them bonds, but yeah, they're crazy cheap. Even though, you know, the thing's gone up 10x, it's still cheap by any metric that I look at. And the same for all the other coal names, even though they've had, you know, a great time.
There might not be an answer to this question. Can you think of any industry or sector sort of like that, which everybody has written off, like the way that they wrote off coal in 2020 today, that you would not write off? I recognize that that's not a thing that's going to happen very often, but do you see any analogies or similar sectors in today's market?
Not that are like, I don't think there are any that are as hated as coal. And obviously what we just talked about, that share price kind of going 10x, like that, the real opportunity was back then. Yeah, it was kind of a once in a lifetime thing where you had something priced for absolute death that was actually structurally doing great or going to be doing great. But this is my favorite investments to look for, is something that is just wildly cheap, hated, and then you dig in on it and it's like, well, wait a second, like this thing has life. Because most stuff it's always like these deep cyclical commodities though, that tend to be, actually, no, I do have one for you. It's just been a giant pit though, and that's cannabis actually. That's something I bought 80% ago and still own, so it has not worked. And the biggest reason is it's very knowingly it's basically just tied to legislation. Like, you get legislation that helps cannabis and it will do great. And if you don't, it's just going to just stay down here and stay hated and cheap and no one will own it. But that is actually a very genuine example of something that is entirely too cheap for how well the industry is growing and making money. Some of the bigger names in the cannabis space, like, I mean, they're creating free cash flow. They have very good balance sheets. They're growing their sales, their customer bases, their popularity. It's something that's penetrating the population more and more when it comes to use, replacing alcohol, the whole 9 yards, but becoming more ingrained in medical and, you know, topicals and cosmetics and like you name it. Like, it's a really nice growing industry, but most people, you know, any sort of like large capital just isn't going to touch it because of the law. Their effective tax rates are like 50% because they can't do any write-offs because they're in the cannabis business to begin with. Like, you can't just write stuff off. So someday there will be legislation that allows them to do smoother banking, access capital better, actually do write-offs and lower their effective tax rates, all this kind of stuff. And then it will have a great bull market. But until you get the legislative changes to, you know, especially to deschedule cannabis, then it's just going to stay down here and be dead money and make me sad every time I look at it.
Yeah, the only one I had, and I'm trying this on. I don't know if I really think this or not, but I wonder if telecoms is a place where you could also see a kind of turnaround, because it's part of the data story, and it's like if we're really going to go 5G and 6G and AI and automation and Internet of Things, like the telecom companies have a role to play. And I know that, like, you know, they have exposure and all the maintenance for equipment and fiber optic cables and all that stuff's becoming more expensive because of the trade war. Yes, but speaking of Mr. Buffett, you know, he's cast his eye at Verizon. Like, you start looking at these beat down telecoms names. I wonder if there's something there, but I also, they've been such dogs the entire time, and I see all the reasons that they are dogs. So I don't know, but I'm always looking for those types of left for dead sort of opportunities in the market.
Hey, maybe I'm something there. I've done zero work on that. I've done
a lot of work on 5G, but like I know all the pitfalls for the telecom companies. It just, something doesn't make sense that like 5G and 6G and all these cellular networks are going to be critical to automation and Internet of Things, and yet the companies that are the gatekeepers are doing terribly. And like they're doing terribly and laying off jobs, but like my AT&T bill keeps going up. So like they're printing money. Like I don't like something there. Maybe somebody smarter than me can figure it out, and maybe there's a simple reason for it. But I don't know, something there maybe. But man, I could talk to you all day, Chase. I can't believe it's been 42 minutes already. Let's talk about Japan for a second.
Yeah, me either. I literally just looked at the clock and got the same.
Yeah, I mean, crazy. So. Let's talk a little bit about Japan. I have not yet had someone on the podcast yet to really delve into what's going on with Japan. And in general, I find Japan much harder to talk about and parse than, say, China. Even though China is the authoritarian country and things like that, there's way more data and way more perspective out there about China than there is about Japan. Japan has always felt a little bit like a black box. We had the initial sort of maybe moderating yield control curve, shenanigans from Japan in the last month, but the last couple of days, you've got inflation going down in Japan more than expected. And when the BOJ was flirting with the yield control stuff, like actually they were raising inflation expectations. So our latest inflation print down for Japan. We just talked about why we think inflation is lower. Perhaps more importantly, wage growth also declined unexpectedly in Japan over the last month. And as Rob and I have talked about on the podcast, we think that's the one you really want to watch, because if wage growth starts really accelerating, getting beyond inflation, that's what Japan has been trying to do this whole time. That's what all the arrows and the stimulus and everything about is trying to get, more wage growth and more stimulation there. So at least 1 month's data says maybe not so fast, and you can already hear like the media narrative is already up. Well, they're going to keep ultra easy monetary policy. It was too soon. The BOJ is not going to sort of turn around, but. Maybe just lay out for the listeners from the larger perspective why Japan is so important, even though we probably don't talk about it enough, and give me your take on where you think the BOJ is sitting today as of August 10th.
Yeah, first and foremost, it's incredibly important because they invest around the world significantly. Like $3 trillion worth of their money is overseas, like on a net basis. So whenever you have no inflation and no interest rates and no stock market growth for 30 years, your people, your institutions take their money and they go somewhere else. That's what they've done. So you have this enormous structure of Japanese investments overseas. And to put that into perspective, things like Australian government bonds, they own 12% of them. French government bonds, they own, I think 6-8%, something like that. So and they're the largest holder of U.S. treasuries. Like they have a lot of money overseas, and it's not just in sovereign bonds. It's stocks, it's private equity, private credit, it's real estate assets. They have a lot of investments overseas, and that's important because that is now like a structural need for all the people they've given money to. So the U.S. needs that money. Australia needs that money. So if all of a sudden they have enough inflation to not just end yield curve control, but maybe raise rates a little bit, then all of a sudden the yen can start to go up. You have like a chunk of that money come home because it doesn't need to be overseas anymore because it can get the same or better returns at home. And so if that happens, then that's a problem for everyone that is losing that capital, and it becomes a massive win for the domestic investment side in Japan as that money comes flowing home. That's why it matters significantly. Plus, they're just the third largest economy. Like they're a big economy. They're a big producer of a lot of important stuff. But when it comes to the yield curve control and inflation, like you're absolutely right. Wages is where to look. And it's been a little bit disappointing lately. But you're also talking again about like a 30-year thing that just became completely normal. There was a story recently, I can't remember where I read it, but it talked about some folks in the private sector getting raises, but like pretty good raises in Japan, and they were literally confused by it. They were like, what is this for? Like the concept didn't even make sense that you would get a raise. So to me, they should keep doing like large public sector raises to kind of just normalize it so that, hey, you're just talking to your friend, like, you're like, you got a 5% raise? Like, I'm going to go ask for one, whatever the case may be, to just kind of make it normal in the culture, at least, because it has no chance until that's the case. But I will say, like, the Bank of Japan kind of looks right for just saying wildly easy. Everyone was making fun of them because their inflation was at a 40-year high and they weren't doing anything about it, not raising rates, keeping yield curve control. And they're like, look, this is all going to go away. It's mostly a bunch of energy inflation and stuff. Like, nope, we're not going to do anything with that until it becomes ingrained and gets into wage increases, because we have no chance until that happens. And I mean, they look right so far. I think they were clearly correct as the rest of the world's bond yields explode higher. Like, you can't keep yours at 0. Like that's kind of crazy. So letting them float up to 1% on the Japanese 10-year clearly made sense. And it will get up to 1. They're just gonna, they're gonna guide it up there, and they're not gonna let it just rip up to that. And I'm sure a big part of that is, the US, Australia, Europe, everybody went to them and was like, look, by all means, take your rates up, but please go real slow so we can keep our bond markets nice and orderly. Because, it's kind of a sensitive time right now with monetary policy globally. So, UK included in that. So to me, it's super important, because if they can get this thing off the ground, it just does wonders for investment into Japan. And if they can't, then if you can't get off this disinflationary island that you've been on for decades in this environment, then I really don't know how you ever do it. And that would be a big signal to me, to the rest of the world, like how hard it is to sustain inflation with kind of their underlying structure of, demographics and everything. That it becomes a signal that how difficult it would be to get off of that disinflationary just malaise. On the investment side, I really like Japan. The problem is now everyone likes it too, so it makes me a little uncomfortable. But they have essentially their companies have just kind of stashed cash and did nothing with it for, again, about 30 years, because their stocks never went up. There's just no point. But now there's a huge concerted effort for all these wildly undervalued companies in Japan to go buy back shares, do dividends, things to bring up their share prices. Maybe even, crazy invest some of the money that you have laying around. So you're getting a lot more capex in Japan. You're getting way more buybacks to support equity prices. So a lot of good things are happening in their equity market. And to me, it's real. Now, can the actual underlying economy stay real for another 5-10 years with all the competition they're facing? We'll see. But as far as the asset price side, I think it makes a lot of sense to have equity exposure there. And then I've been stupidly liking the yen now for about a year, and it's just been dead wrong. But I just figured they would get to the point where they could normalize a little bit, on the monetary policy side, and then enough money would cash in their chips around the world and bring that money home, and that would be enough to support the yen and at least have it kind of flat, but not so far.
No, they're not they're not there yet. Hear that. That they're not there yet. I mean, I sat up a little bit in my chair when they just said they were going to let bond prices float up a little bit, but then when you see the the new data and things like that, it doesn't look like things are quite there yet. A couple of thoughts on just like the sort of strict geopolitical side. We already talked about LNG in Japan. Japan was really what led the LNG revolution. It was cost effective for Japan to go after LNG when it wasn't for the rest of the world, because of how dependent Japan is on energy imports. And the fact that everybody else is now interested in LNG means that Japan has to look other places. So I sort of think of Japan as the leading indicator for what's next in energy markets. And I think it's going to play a very similar role with demographics, because like everybody talks about Chinese demographics. Japan's way older. Like Japan has been declining for years now. Japan is going to be ground zero of what demographic decline looks like, and how modern industrial economies can they negotiate sort of the trade-off between lower growth but declining population and things like that. And that's going to mean things like automation and productivity, and Japan's going to be at the front of that. And that's why, in some ways, the sort of most important thing I've seen out of Japan in the last couple months was the data they released that said that the foreign population of Japan increased something like 10% year over year. Now, we're still starting from a very, very small base. We need to see a couple more years of that and much larger numbers. But if we're getting that kind of cultural change, because I don't think we're ever going to see a cultural change in Japan where the average Japanese worker goes in and says, I demand a raise. Like, I'm willing to say in our lifetime, we probably won't see that kind of cultural change. But if Japan realizes, hey, we have to import immigrants, and maybe we have to figure out some kind of, maybe they're not Japanese citizens, I don't know how they're going to do it. But if they understand that they need to bring more people into Japan, and that they can figure out how to sort of thread the needle between, tech for productivity and, bringing in labor and things like that and figuring out how to drive down the cost of energy. You put all those things, like that's the thing that has to go together. And then just the last thing is that Japan is more exposed to the Chinese economy than arguably any other major modern industrial economy in the world. And I think Japanese companies are again here leading the way. They're not completely leaving China. What they're doing is they're saying, okay, we're going to set up Chinese supply chains and then everybody else supply chains. And so you're getting some capex where it's like, no, we want to sell into that Chinese market, even with all the problems with China and political tensions between Tokyo and Beijing. Like, we will have one supply chain that sells into the Chinese market and then one supply chain that our Western allies and everybody else is going to kind of utilize. And I wonder if that's going to be a picture of where things go in the future. But in some ways, I think that's their biggest risk, because all these Japanese companies, they've all taken big bets on China. And if China's about to fall off a cliff or something like that, like, I don't care how much wealth is stashed away in foreign capitals and things like that. You're not going to do enough if you're sort of the economy that you have the deepest relationship with is going off the cliff. So it's weird to me sometimes that that there are these armchair geopolitical analysts out there who are like, I'm bullish Japan and bearish China. Like, something doesn't work in that equation. Like, they're both parts of the same whole.
Yeah, it's very true. And I mean, they've gotten a lot of trade concessions with China in the last few years. So that would be very difficult to walk away from when you finally kind of like get some help on tariffs and things, like all of a sudden from then kind of walk away. So you're right. Like and that's like I was saying earlier, as China as the global macro keystone, especially the Asian macro keystone, like it's just really difficult for Japan, Korea, Southeast Asia, like you name it, like anyone in the region, even Australia, New Zealand, like it's really difficult for them to really get going when China's not doing well. And clearly at the moment, China's not doing well, and one of the biggest questions in the world of geopolitics and finance, both, I think, is like how does China handle this stuff from here? And I think a lot of people use the Japan analogy on China, and to me, so far, it fits. Like, it's just that it slows down to kind of nothing, and it just moves sideways for years and years and years. So that's, at the moment, that looks like where we're going. It's you do that, or you do massive structural reform stuff that sure feels really difficult for them to pull off. I mean, Xi's been in power for a long time. They've been talking a good game about consumption for over 10 years, and we don't really get anything. So it's kind of hard to imagine. And you think about back to that like 2009 giant stimulus, like, I mean, Xi's done nothing even close to that. But I do keep saying, like, the guy 180'd on the lockdowns, the guy 180'd on his trade spat with Australia. He's done several 180s. So it's not like it's impossible for him to be like, you know what? Yeah, let's do some big stimulus. Let's get after it here. Like, I mean, it's not impossible, but man, it sure feels like that is like firmly against his philosophy. And if they don't do that, like you just look at the inertia, the structural inertia, the demographics, everything in China. Without doing something big, it just feels like it's pretty obvious where you're headed. I think they're starting to understand, like, hey, at least short term, like, we have a really big confidence problem, a really just like an animal spirits problem, and we have to fix that. The problem is I just don't think they know how to fix that. Whenever they put out that document that talked about, oh, we're gonna do some food festivals, I just could not believe. And that was when like Wall Street was looking for like a bazooka coming out of China, and they're like, no, it's fine, we're gonna do some like block parties, and then like everyone's gonna get fired up and buy a bunch of stuff. Like, what? Like, I'm still shocked by that whole thing. But so far they're not taking the stimulus serious. Like, cool, you can cut rates, but that's gonna do nothing. Like, no one's out there not buying an apartment or a car or traveling or investing. Like, that's not holding anyone back. Is like, oh well, how about another 10 basis points off your mortgage? Like, no, like, I'm not buying a house because of that 10 basis points. It's because you basically told me to stop buying houses and the prices went down. Like, policy out of China has made no sense to me for a while now, and until they do something big, it's just gonna yeah, they're just going to go the Japanese way, I think. And that makes it really tough for their entire region to sustain the growth they're used to, unless they just begin to kind of replace China in certain important ways. But we'll see.
Yeah. The listeners probably don't want to hear me rail about electric vehicles again, but China's also taken the step where they want to be the electric vehicle maker, and part of one of the state council's new stimulus measures is okay, take a discount on your electric vehicles. I think there's also a warning signal in there for everybody else in the West who's betting the farm on electric vehicles, because China's showing you right now, is that really the right bet to make? But that may be sort of a separate issue. But one other thing I just want to bring up there is that, China, the current iteration of the Chinese economy came in an era of globalization. And if you were going to continue, like, let's say the trade war doesn't happen. Let's say there's no chocolate cake meeting between Xi and Trump and everything continues friendly and everything else. What you would expect is a period of disruption here, but where India and other parts of other parts of Southeast Asia would take the place of China for sort of lower price exports and things like that. And China would ascend global value chain, and there would be disruption, and you'd have to redistribute wealth and things like that. But they would slowly rise in the same way that the United States rose from the 20s, 30s with its own sort of dislocations and things like that. The problem for China is that we don't live in a globalization world anymore. So you can't kind of depend on that. And then the only other hope that they had was, okay, we're going to be the center of AI and tech and everything else, and the productivity gains we're going to get from all this cool tech is going to allow us to grow past the problem to 24 and 25. And Xi Jinping made the mistake of saying all that out loud, so that the U.S. government said, aha, we will now crack down on the things that will make China sort of a growth story going forward. But getting this back to Japan, this is where the Mark Twain quote that gets used way too much, that history doesn't repeat itself, but it rhymes. Japan's geopolitical interests haven't changed since 1945 or since 1900 or, even before then. What Japan was trying to do in the 1930s and 1940s was build an empire, an Asian empire that didn't have to be dependent on the Europeans, that had all the resources that it needed, and everybody was interconnected and economies of scale and things like that. And everybody talks about China's Belt and Road. Japan's infrastructure spending throughout Southeast Asia and its investments throughout the region dwarf what China's has. And Japan still, I think, and all of Asia has an interest in stitching everything together so that economic development and growth and all these other things can happen. And that's why it's really important to watch what's happening in a country like Indonesia, and why it's tremendously important that India doesn't want to play ball, that India is still protecting all of its industries, that it's sort of 1 foot in, 1 foot out. So I think that's another headwind here. Like, China's economy was made from globalization, and you've pulled globalization out from underneath them, and that's going to hurt them more than just about anybody else in the world. For the record, it's going to hurt everybody. Like, I think it hurts everybody in the world, but China was really the tip of the point of the spear for globalization, and it's going to hurt them the most as we revert away from it.
Yeah, I mean, we already see it, and you talked about India, Indonesia. I think it's really impressive how well those two have done in the last, say, quarter, considering how bad things are in China right now. Even like Taiwan, Korea, like I've been impressed with Asian resilience in the last 6 months to the malaise of China. Like, so maybe some of that maybe some of that's further along than we realize with some of the diversification and them taking the place of China in certain ways. Like, we know, Apple wants to move a pretty big chunk to India, things like that. Like, maybe there's just more of that happening. And something else I'll say is, obviously, the upfront costs and the build out for, this minimizing or restructuring of globalization is inflationary. But then again, I do think you look at things, the cost to produce something in some of these other countries versus China is a lot less. Like, labor's cheaper. So if you move a factory from, especially China to Mexico, yeah, to build it is kind of inflationary. But then on the back end of that, at least for a while, it's cheaper. Like, that, it's not inflationary. It's the opposite of inflationary if you reduce the cost of some of this stuff. So all I will say there is that there are cross currents in the inflation versus disinflation debate when it comes to re-globalization, whatever you want to call it, deglobalization. And I think it's something that people don't think about enough, because China was getting pretty expensive. Like, we already had a lot of stuff just on its own before the trade war, being like, oh, well, let's go to Vietnam. So let's go to, wherever it's going to be. What's funny is, like, we all make fun of Russia as the gas station in the world and all that stuff, or gas station for China. The more I think about it, and the more, like, this environment kind of crystallizes, the more I kind of view China that way. Like, yes, like, they're gonna sell a bunch of EVs and stuff, but I mean, I wouldn't be surprised if the world just gets together and be like, hey, how about no more Chinese EVs, really, to just kneecap their industry and keep it domestic, or just slow it down. Things like that. Like, they're okay with technology, but I mean, they try to do the semiconductor thing, and it's basically been a large failure, other than the ones that were cool 10 years ago or whatever. But we all know all the stats on all the mining and refining they do for all the important stuff. So to me, like, they're almost like the gas station for, but for, like, metals, for higher, they're going up the value chain, but on commodities, not on technology of producing the stuff, the end use, the way we talk, Indonesia's kind of got up the nickel value chain, and they've done more processing and refining, and then, building it out to make cars or whatever. Like, that's great. Like, to me, I can easily imagine China's like, hey, that's where you go buy raw materials, but, like, they let them get halfway up the value chain, all the dirty refining and processing that no one else wants to do, and then you buy it from them. And that, I'm sure that's not where they want to be 20 years from now. They want to be like the quantum and AI and all that, like, leaders. But I could imagine a scenario where it's like they fail on most of that stuff because, the top-down system and not being good to entrepreneurs, and not really being great, producers of creativity in general, or risk-taking. Like, it makes it tough to go all the way up the value chain that way. But, maybe we are all still buying our exotic metals from them, 10 years from now, and they just carve that out as their niche. I don't know. That's just me, like, truly just thinking out loud, and something that just crossed my mind.
I'll close with just two thoughts. You're right that it's cheaper probably to move a factory from China to Mexico in sort of absolute terms. The problem there is capacity. The thing that China has always had more than anybody else is capacity. There's 1 billion of them, and they have, like, the rule of law maybe is not what we are used to as the rule of law, but if you set up a factory in China and the right people have blessed your, endeavor, like, you're going to be able to do whatever you want. You can't really say that in India or in Mexico. And, countries like Vietnam, they're at capacity. Like, if you're trying to move into Vietnam now, they don't have the power, they don't have the land, they don't have anything else, which is why, if you're, say, Japanese companies with a pile of cash to spend, and you have these countries like in Indonesia or a thing like that, if you can spend the money to create that kind of ecosystem, 5-7 years, you could really reap the benefits. If you're a US company, let's say you're an Apple or something like that, you want to start making iPhones in Mexico, and you're willing to spend a pile of your savings on building, capacity in Mexico. It's going to take some time, but if you can help build out that capacity, yes, absolutely, you can sort of get to the same sort of position there. So I take your point there. I think it's going to take probably a little bit longer than you're thinking. And the second thing I was going to say just went out of my mind. We were talking about, China. Yes, they refine all these metals. Like, it's going to be their province. Like, we're dependent on them for that, and they're dependent on us for technology. I just go back to something that Marco said on this podcast maybe over a year ago now, which has really stuck with me, which is, China doesn't have to be the cutting edge to get success. Like, they don't need 3 nanometer chips necessarily. Like, they don't need to be at the absolute cutting edge of all these things. They just have to be good enough. They just have to be self-sufficient enough so that they can do the basics of these sorts of things. And I say that and point out that Huawei, which everybody left for dead after the Trump trade war and all the 232 investigations and restrictions and things like that, Huawei says it's coming back with selling smartphones in the Chinese market probably at the end of 2024 with chips made in China by SMIC. They're probably going to be the 7 nanometer variety, maybe not even, maybe less advanced than that, but they're coming back and they're selling it to the Chinese market that way. So take your point on the pitfalls of creativity and entrepreneurship within an authoritarian system, but at the same time, like, can it be good enough Can you get enough Chinese companies selling now to 1 billion Chinese people who now have this nationalist incentive to buy there? And you've got sort of the state and also companies recognizing if we are self-sufficient in these things and we can do just good enough that we're kind of going to get there. I mean, that's the world I think China has to inhabit. And it's not the glittering AI quantum future that Xi outlined even a couple years ago, but it's a more realistic, grittier version of where China, like good things do happen in China, even with all of the problems that we talked about.
So yeah, I've heard Marcos say that a few times, and I think near term, that's clearly right. And one of the points he's made is like, look, it's not like the missiles right now have 3-nanometer chips in them, or you need that. Like, you can have 30-year-old technology and be fine with that stuff. But I will say, when it comes to both warfare and just kind of winning in where we're heading in with technology and in the economy, like this borderline singularity, like just how much we're accelerating on the scale of technology and how it's building on itself. I do think you at least need access to that stuff, and it gets to the point where if you could do it yourself, it's just such a big deal, or at least have profound access to, say, a 2-nanometer chip a few years from now. Like you could have a winner take all thing where if one country can do really like some really hardcore general AI and quantum, and then the other country can't, they just lose. Like, it's winner take all at that point, especially from a warfare perspective. Like, yeah, you can have a missile with a crappy chip, but 20 years from now, whenever you have things working very like on a lot of automation, they can think for themselves and maneuver for themselves and avoid threats for themselves because of AI. If one person has that and one person doesn't, I mean, that's like you're basically at the point where one side has rifles and the other side has bow and arrow. Like it just becomes a problem. So today, sure, like who cares if your missile's a little bit smarter than mine? Like, let's go. But I think you can at least make the argument you're heading towards a almost like singularity induced winner take all. So I would just warn that being able to be at the cutting edge of chips is going to get more important. And I think that's why you see everyone taking that race so seriously.
No, I take it. It absolutely does matter. It's just like when we start getting to that level of competition, then we can like wake me and we can start talking about Chinese, Taiwanese, or China invasion Taiwan scenarios. Until we get to the point where China can even imagine that it's on some kind of peer level from a tech basis or a military basis, they're shooting water cannons at the Philippine Coast Guard in the South China Sea. Like, that's as adventurous as they're probably going to get here over the next couple of years. I'm probably going to rue that comment.
Hey, but I'm like you, like that kind of stuff. That stuff worries me more, at least in near term, than anything else. Like, I think people forget like how that defense agreement between the U.S. and the Philippines, like that's just as sketchy for starting a war as Taiwan is. So, and no one cares about that one. Like, no one, like, nothing could happen at the Philippines that would get DC's attention. I think all the pundits in the Beltway, like one little thing happens around Taiwan and everyone freaks out. But like the Philippines are like, whatever, who cares? Well, I don't know. That could easily be a place where something starts.
Who cares is the Philippines. And like we saw, like the election of Duterte and the turn towards China for that brief period was because in 2012 with Scarborough Shoal, we didn't come to their aid. I don't think this most recent thing is going to amount to much. But to your point, like China, if I'm China, what I'm really trying to do is flip the Philippines. And the way I flip the Philippines is create some kind of security crisis that does not amount to like an invasion or anything like that, but just enough to make the Philippines feel like, hey, the United States isn't going to help us any more than they helped Ukraine or Georgia or anybody else. Maybe we need to start hedging our bets a little bit. That's where China really can make some moves, although it's been unsuccessful. It's been a very bad year from them from that perspective so far, because you have this new South Korean administration, very pro-U.S., this new Philippine administration, very, very pro-U.S., but that I think is the long game. And yes, to your point, I'm making jokes about water cannons in the South China Sea, but I'm sure that I'll rue the
No, I know you're taking it seriously. That's all you're talking about.
There you go. All right, Chase, we'll have to leave cotton for another time. I'm not going to take more than 70 minutes of your time. Thank you for being so generous with it, and I'll talk to you soon, okay?
All right, sounds good.
Thank you so much for listening to the Cognitive Dissidence podcast, brought to you by Cognitive Investments. If you are interested in learning more about cognitive investments, you can check us out online at cognitive.investments. That's cognitive.investments. You can also write to me directly if you want at jacob@cognitive.investments. Cheers, and we'll see you out there. The views expressed in this commentary are subject to change based on market and other conditions. This podcast may contain certain statements that may be deemed forward-looking statements. Please note that any such statements are not guarantees of any future performance, and actual results or developments may differ materially from those projected. Any projections, market outlooks, or estimates are based upon certain assumptions and should not be construed as indicative of actual events that will occur.